This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with an experienced private markets and distribution executive who has been educating the wealth channel and distributing private markets investment solutions at some of the industry's largest investment platforms. We sat down in Prudential's Newark studio with PGIM's global head of alternative investments, Dom Carlino. PGIM is the $1.4 trillion global asset management business of Prudential Financial. At PGIM, Dom is responsible for driving the continued development and distribution of alternative investments tailored to the firm's wealth channel investors globally. Dom joined the firm in 2023, bringing over 20 years of experience in alternatives distribution. He was most recently MD, head of alternative investments distribution at Merrill Lynch. Dom and I had a fascinating conversation about the intersections between insurance and asset management and the evolution of distribution. We covered how the distribution of private markets investment solutions has evolved, the benefits of an integrated platform across insurance and asset management, navigating the playing field of collaboration and competition between asset managers and insurance companies, the importance of education, the how, why, and where evergreen funds will be adopted. Thanks, Dom, for sharing your perspectives and wisdom on insurance and private markets. We hope you enjoy.
In a collision of culture and finance.
We're going mainstream.
Dom, welcome to the Altco's Mainstream podcast.
Thanks, Michael. Welcome to Prudential. Welcome to PGIM. Welcome to Newark, New Jersey.
Appreciate it. No, thanks for having me. First of all, fantastic studio. We'll get to that because I think marketing, branding, messaging, particularly when working with the wealth channel, is so important. So it's nice to be in a studio that encapsulates that in some respects. I'd love to first start with your background because I think that's so informative in a number of ways. One, your experience in private markets. Two, you decided to move from the wealth side to the insurance side and asset management side, given Prudential's capabilities. So we'd love to just start there and hear how you got here.
Yeah, no, happy to. It's interesting. My career spans 30 years, 25 of which touches alts. I actually started on the long-only side years ago, and then spent some time on the research and investment banking side. So I spent time valuing companies and understanding capital structures and what have you. So that was really instructive to my career today. I switched to the distribution 5 and 05. I went to Morgan Stanley and was distributing alts through institutional channels there, as well as their MSSB wealth channel. So it was a great opportunity to kind of educate around and distribute a wide swath of alternative strategies across asset classes and the relatively fewer number of structures that were available at the time. So we saw the uptake there. It was predominantly an institutional kind of uptake where pension plans, endowments, foundations, others were consuming alts to a larger extent. And it was more of an emerging sort of wealth opportunity. So sort of started on the asset management side there, went to Merrill in 2012, 2013, and spent 10 years there before coming back to the institutional asset management side. And so it's been quite the journey.
I'd love to unpack the Morgan Stanley and Merrill journeys that you had. So I think, two firms that do a lot in private markets, particularly at the private banking side. What do you think you learned most from those experiences that you've now taken to where you are at Prudential?
You looked at the evolution on the institutional side, and it took a lot of education there. And the space 20 years ago was heavily intermediated by consultants like it is today. And in order for this sort of the new technology to be adopted and understood, so there's a performance characteristics, the risks, you had to do sort of a push-pull through the consultant, through the plan sponsor as an example. And so it took time, right? It took time for all the stakeholders to kind of get comfortable with this sort of new and emerging technology, which had risks that weren't fully understood and was sort of a heterogeneous space, lots of kind of flavors and colors to kind of parse through. And it's sort of a similar thing in wealth. It's sort of taken time for wealth to get there. But wealth now going through its evolution of, kind of educating all the key stakeholders, kind of commensurate with that, more product development has happened and more supply is available to wealth. So it's interesting. When I got to Merrill in 2012, 13, it was a little bit of a negative selection in the market. There's more limited supply of institutional alts capabilities for wealth. And so you're trying to architect a product platform that kind of cuts across all the sort of key dimensions of risks that you want to provide to advisors and clients. And sometimes, you struggle with fulfillment, right? So you wanted asset class coverage, you wanted structural coverage, you wanted geographic coverage, different risk levels, different liquidities. And so it took time for the market to catch up. And there were some early players in the market that sort of committed to wealth with alts. And I think, we know who some of those folks are, and they executed well. And I think the wealth community partnered really effectively with the asset management community to make sure that they were fully aligned on the educational requirements, sort of the product development requirements, the distribution requirements, the operational requirements, and the market slowly evolved that way.
When did the light bulb turn on for you that the wealth channel is really here to stay and this is going to be a big part of private markets going forward?
Well, we saw some of the more progressive, sort of, smarter alternative asset managers view the opportunity in that space and kind of frame it in a way that made it a really compelling opportunity. Now, understanding the opportunity and committing to it are two different things, right? So back then, you kind of looked at the traditional institutional, pools of money, and it was sort of defined benefit, which, at the time was a $5 trillion market and shrinking. Public pension, roughly $6 trillion and pretty fully allocated. E&F, smaller, allocated. And then you look at wealth management, and here at the time, it was a $40+ trillion behemoth that was 2% exposed to alternatives and growing. So it was kind of the Jupiter in the solar system of planets, right? In terms of wealth opportunity and capital opportunity. And so the early progressive alts managers saw that and said, okay, we need to invest. So we see the opportunity, now we need to commit, even if that means incurring a J-curve. So they invested in product development, they invested in distribution, they developed educational platforms, and they got proof of concept early. It started working, and then others started to see it, and others started coming online and committing to the space. And now it's a full-on arms race. So.
Speaking of arms race, I think it's so fascinating to think about your career as kind of emblematic of where we are in this intersection of private markets, private wealth, but also insurance. If you think about, at least from my perspective, the two largest pools of capital that can participate in private markets that everybody's trying to figure out how to work with, and firms are trying to figure out how to play in private markets, are wealth management and insurance. Prudential encompasses all three of these major trends: wealth management, insurance, and asset management. Why make the move to Prudential?
Yeah, it's interesting. I had the privilege of facing off with lots of asset managers over the years in my prior role as sort of a gatekeeper, right? And some of those were more monoline, single strategy focus. Some were broader in their orientation. And we as a wealth platform at the time had a certain amount of manufacturing capacity, right? Whether that was sort of, originating the manager, negotiating a selling agreement, doing the distribution, all of it. It took a lot of resources. So scalability of manager partners was important. Folks that can partner with a wealth firm in delivering the education, sort of the advice and guidance, helping with the product development, being innovative in that, and having sort of a steady stream of compelling opportunities to kind of feed the beast, if you will. And then also supporting on the distribution side through, education, transactional process, post-sale, operational support, what have you. And so manager scalability, became really important over time, and few managers really had the breadth of capabilities and were fully committed to wealth. And so I looked at across the universe, and I looked at some of the more traditional platform firms, some of which were insurance owned, many of which were not. And here's a breadth of capabilities across sort of public and private markets in a lot of cases. In the case of Prudential PGIM, there's the insurance company on top of it too, right? So here, to your point, leverage to a lot of growth opportunities, lots of capabilities across public, private markets, leverage to the retirement solutions business, leverage to insurance. So when you think about a firm like Prudential PGIM and their ability to meet any number of client goals, it's pretty profound, right? It's pretty impactful. So, to think about the various financial goals that an advisor and their client are trying to solve for, we can meet a myriad of those goals.
I'd love to unpack that a bit further, because I think only through hearing what that really means, you can really understand the gravity of having such a massive platform. But what does that actually mean to be able to have all of these capabilities? You were on the wealth side. You were at a large global bank that had a private banking capability. What about Prudential and what you have is built for private markets today and going forward?
Yeah, there's a scale and longevity story here that's very unique. There's also sort of this asset liability machine that we have that's sort of self-reinforcing, right? So we've been an insurance company for 150 years. So we've been sourcing liabilities for a long time and matching assets against those. And so, this is permanent capital where premiums are paid on an ongoing basis. There's an ongoing cash flow, and there's this virtuous cycle of sourcing liabilities and matching assets against those. So clearly we do that with our, in-house asset management capabilities, which is, a substantial competitive advantage for us. And then, we'll selectively partner with third parties to, sort of fill in gaps, where needed and add more capacity. But, that ability to have those sort of long duration liabilities against which to put these assets is very attractive to the market. And this is where the intersection of asset management and insurance is happening and why it's happening. And so you talked about a number of key trends, sort of public, private, insurance. We'll probably get into, alts and retirement, which is obviously the next big frontier for a lot of asset managers. We've been in those businesses for a long time. We've been in insurance for 150 years. We've been in private credit since 1925, so 100 years now. We're the first open-end core real estate fund in 1970. So we've been at this for over 100 years through 30 or so market cycles.
There's a number of things in there that I think are really interesting when you think about a lot of the trends that are happening today. But one of them that's also related to wealth management is it feels like more and more investors are thinking about private markets through the lens of asset liability matching and how to think about total portfolio construction through that lens. Why is that important to think about, and how does being an insurance business kind of help you think about that?
Well, we have an insurance business. We have a bunch of really smart actuaries, on the team here that can kind of precisely measure the duration and the magnitude of our liabilities, right? And when you think about individual investors, we all have our own balance sheets, right? And we all have goals. And so when advisors sit with their clients, they do a financial plan and they want to understand, what do your liabilities look like? What are the timing of those? What are the magnitude of those? And how do we build the asset portfolio to sort of match that and make sure that we can fund everything near term and in the future? And so, that asset liability matching model is in our DNA. It's what we do. We do it exceptionally well. And that transfers really well to wealth, because I think more and more they're thinking about it that way.
I think that also gets to some extent the core of private markets, which is there's a number of different risks that investors can take. One of them is liquidity risk or duration. And when you think about that, I think allocators can think about things differently. Private markets can play a role in that. How do you think that aspect is shifting in investors' minds or allocators' minds that maybe in certain parts of the portfolio, they should be thinking about liquidity risk differently? Most people probably don't need liquidity everywhere within days. And some markets also may not have liquidity in days, even if they're more quote unquote liquid markets. So how does the element of private markets kind of change some of that thinking?
Well, it's interesting. When we think about alternative investments, right? These days, people talk about it in the context of private markets. But it wasn't that long ago that the focus was more on hedge funds and their public market strategies, right? And, alternatively applied. So more and more with these public-private sort of tie-ups and these strategies that are being developed, we're viewing it more as a fluid continuum, right? That's for like liquidity management purposes, exposure management. And so, we look across these public and private exposures, understanding that, private equity, real estate, they have an embedded beta and it's hard to measure, but they have it. So we need to understand sort of quantitatively what our exposures are. And to your point, how that evolves over time. Because, these betas are not static, right? Different economic regimes, different liquidity regimes, the risk could be more pronounced or less in alternative investments, depending on the backdrop. So I think there's more of this sort of sophisticated institutional allocator approach, coming to wealth, which I think is great, right? We've gone a long way from, hey, there's private equity, real estate, credit, to, hey, let's get under the hood a little more and look at the exposures and how they behave in different market environments and what outcomes you're trying to sort of solve for.
What do you think it'll take for investors to understand and really grasp the concept of liquidity risk and where to take more liquidity risk or take on illiquidity in exchange for potentially higher returns? Obviously, maybe taking on a little bit more risk. But how do you think investors' mindset might be shifting there?
Yeah, I think we just have to continually educate, right? And we've launched, as an industry, a lot of evergreen products, which we position as long-term investments. They provide an option on some liquidity, but we don't really want advisors or clients to view them as liquid necessarily, right? Because there are some liquid, illiquid assets that belie those. And so I just think it takes a lot of education around that. The structures themselves provide sort of protections for the fund in the event of strained liquidity. So there is a mechanism embedded within the structure, but it just requires a lot of positioning, a lot of education.
We talk about education. I think the other element here, particularly in the world of private credit, which is growing, you have a very large credit business across public and private credit, is the issue of question of credit risk within particularly insurance portfolios. How do you think about that? And how do you make sure that some of those risks maybe are muted when it comes to adding things like private credit to whether it's insurance or end client portfolios?
Yeah, there's lots of flavors of private credit, and you're right. We have $1 trillion, fixed income and credit platforms. We're one of the bigger players in the market, and we play in lots of different segments, lots of different asset classes of credit. And so, we're fundamentally a conservative company, and we really seek to actively manage credit risk, right? So we're not looking to provide you with just, private credit beta. We actively manage the risk. So we make sure we have the right covenants in place. We make sure that our entry leverage into a company is sufficiently low and meets our underwriting standards. So I just think we're sort of core blocking and tackling lenders who, really believe managing that credit risk and having discipline around that is important. Even if that means we sacrifice a little bit of scale, a little bit of growth in the process, we're going to stick to our knitting. And so when the environment gets tough, we're going to see who's kind of providing, cov-lite, credit beta versus actively managing the credit risk.
How do you think about that aspect of things in the context of, one, as a platform, you've decided to be more vertically integrated, but two, you've also acquired firms with certain capabilities to add to the platform across the different strategies that you have. How do you think about bringing strategies in-house and evaluating managers and their DNA to make sure that they meet and fit the DNA that Prudential has?
Yeah, I think that's a really important point because there's some obvious areas where bringing on more capabilities, either through acquisition or strategic partnership, will be helpful as we develop more sort of multi-asset capabilities. Now we have, to your point, most of the component parts under our roof, so we are fairly well, integrated vertically already. We are seeing a lot of players in the market go out and partner and acquire with firms, and I view that as more of a horizontal integration, but we have most of it. Now we still are on the hunt for other things, sort of maybe tuck-in acquisitions or strategic partnerships that we think will supplement and be complementary to what we're doing. I do think managing the cultural piece is important, though. Clearly, we've been doing things a certain way for a long time. And so making sure there's that cultural fit in terms of how we operate would be important. Always being open to new ideas, but.
How do you think about this concept of partnership versus frenemies versus enemies in this space? Because you're both an insurance firm. Insurance firms have partnered with alternative asset managers. You're an asset manager. You've done partnerships. You've acquired firms. How do you think about navigating this whole space when it comes to build, buy, partner?
Yeah, so we have historically been an organic growth shop. And, that's sort of fundamental to our DNA, and that'll continue to be the case. We will continue to be looking for acquisitions selectively. I do think strategic partnerships are something that we'll engage more on. And, we've had a number of firms express interest in partnering with us, which we think is great. And so there will be opportunities there for us in hopefully not too distant future.
How do you think this all shakes out? Because in certain categories, scale really does matter. You see traditional asset managers getting into private markets in a big way, whether through acquisition or trying to partner with firms. As you think about the way you answered that last question, how does this whole space shake out? Is it a small set of firms win? Is it room for specialists winning in their categories, partnering with bigger platforms, or some other motivation of all of this?
It's a great question. I mean, we have seen this race to scale, right? We've seen the M&A market be robust within asset management. We've seen the GP staking market be robust within asset management. So people are trying to scale up to pursue the wealth opportunity. I do think, there will be a bit of a shakeout because there are some firms that are, prosecuting some strategies sort of off the side of their desk, and, maybe it's not core to them. There's a number of firms that have sort of put together, a number of capabilities where, to your earlier point, it may be challenging to sort of integrate that. I think what the market wants to see, and I think what we present, is more of a, kind of a seamless, again, vertically integrated, sort of structure where they can look across and see sort of top tier capabilities across, real estate, credit, infrastructure, public market strategies, with sort of the Prudential halo on top, right? So there's sort of all these capabilities from an asset management perspective, and then there's this sort of organizational alpha that comes with it too. And I'd be remiss if I didn't mention distribution as well. We have, an army of distribution people globally. We have nearly 250 people globally that face off with our clients, pre-sale, during the transactional process, and post-sale.
I'd love to break down each of those pieces, the product set, the organizational alpha, and then the distribution. So if we think about product set, what do you think having this broad-based platform does? And what I'm really trying to get at is, does it make you think about the ability to dream up product construction differently? Like maybe you find ways to combine public and private. Maybe you find ways to create multi-asset solutions. Is there ways that you think about this differently given what you have on your platform?
Yeah, we have so much raw material to work with. And so, it is a toolkit that's very broad. So public-private, we have a north of $1 trillion public business. We have a $330 billion private markets business. So there's a lot of raw material there. And again, we're at scale in most, if not all, of those businesses. We have longevity, decades in pretty much each of those businesses. So, we're sort of scaled, cycle tested, very experienced. We have market leadership position, number 3 real estate manager globally, number 2 privately placed debt manager globally. So having those be a la carte options are obviously attractive to the market, but putting those together in different combinations, we think will be really important. Sort of best of PGIM in different varieties.
You've been on the other side of this, both Morgan Stanley and at Merrill. If you put on your gatekeeper hat, what do you think end clients and their advisors want? Do you think they want less solutions, not more? Do you think they want combined solutions, not individual solutions?
Well, advisors and clients are obviously, it's a heterogeneous set, and it's not a monolithic group that all kind of moves together and has the same appetite. But I do think more ease of use as relates to implementation, more simplified sort of turnkey exposures and alts will be increasingly important, whether that's within a single fund or, a model portfolio. I think the ability to kind of transact more simplistically to get a diversified exposure, whether it's in a managed account construct or some other guided way, I think will be really important to move this market forward and to increase the penetration. Today, we're still only 3 or 4% exposed within client portfolios. And I think the denominator is growing faster than the numerator. So I think there needs to be more simplification in terms of implementation to get that higher.
How do you think about the different types of products you have and making sure you're delivering the right solutions to investors?
Yeah, so we have traditional QP, closed-end drawdown funds that the market grew up with, and obviously, there are advisors and clients that still desire to have those. Evergreen has obviously become very, very prominent. We've seen massive growth, far outstripping the traditional closed-end fund side. Mm-hmm. I think there's something like 300 evergreen funds just in the U.S. today, 58 in registration. That number is expected to double in 5 years, right? And a disproportionate amount of the flows for the large wealth platforms are going to those evergreen products. So we're going to have a mix of evergreen sort of core and non-core strategies that we'll bring to the market, and we're in market today with a few.
What do you think is still missing that the market wants or needs?
Yeah, I think it goes back to more turnkey options, right? I think things that give diversified exposure with more sort of transactional simplicity and the ability to allocate, across your book, if you will. I think the evergreen structure has been well received because it provides lower minimum investment, lower suitability, easier tax reporting, you're fully funded day one. I just think there's a lot of virtues to that structure that the market really appreciates. And I think, to migrate to the QP structure, so there's more of an illiquidity premium and kind of a structural risk premium that has to be provisioned.
What about from a strategy perspective?
Well, it's interesting. I think the market is pretty kind of full up on some of the core categories, right? So direct lending, obviously there's lots of sort of supply there, real estate, infrastructure, more coming there. It was a little later, but a lot more options. Private equity, same thing. I do think we're at a point now where more specialized strategies, not just within the QP fund structure, but within Evergreen.
Like what kind of structure?
Well, it could be sector specific, right? Global data centers, maybe it's, industrial real estate, hospitality, single family rental, any number of things. But I do think the market's ready to evolve beyond just kind of the core exposure to the more specialized asset class.
I think that brings us to we'll get to organizational alpha in a second, but that brings us to the third layer of all of this, which is distribution. Tying what you just said to the distribution side, how do you think that you then effectively educate both your distribution force as well as them educating the advisor and client on whether it's more known strategies or as you get to a market where there's more specialized or niche strategies? How do you think about the whole education process as it comes to distribution force as well as them educating the end clients?
Yeah, the market's come a long way from an education perspective. I remember in the early days, there was not a lot. There were some white papers, but it was pretty sparse in terms of the educational collateral. But today, and as it relates to educating our distribution force, this is a very experienced team that has sold complex products. You may or may not call them alternative, but they know how to sell complexity. And so, getting them trained up, we have a very structured training protocol that's part sort of top-down, digital, a training portal with access to white papers, thematic research, ABCs of alts, the how, what, and why, and then some sort of self-study modules as well. We also partner with Kaya and some other sort of third-party accreditation firms to expose them to their content as well. And then we do in-person trainings too. I think the key for our distribution team is to make it flexible, sort of modular, because they're very busy people. And so we want them to be able to engage when they have time and how they want to digest it. So, it could be through a podcast, it could be through a white paper, it could be an in-person training, and we provide optionality around all that.
Is there, on that point, sorry to interrupt, but I think this is an interesting point to double click on, which is there a specific skill set that you think makes a good distribution professional and a good distribution professional for Prudential? Because as you say, you sell complexity. What does it take to be really good at distribution?
Well, I think a lot of it has less to do with the subject matter expertise. We can help them with that through the training, but putting people with them, in a sales situation or an educational situation, it's really about capacity management, time management, capacity management, knowing what you know, knowing what you don't know, and knowing when to stop as you're educating or selling. Right? Because we never want our wholesalers to get over their skis. So, we educate them and we train them. Hey, when you get to this point, this is when you bring in the relief pitcher, if you will. And so I think that's an important skill set, knowing what you know, not going too far, and then bringing in the resources you need, subject matter expert resources in particular.
How have you constructed your distribution team to handle everything from the opener to the middle to the closing, or being the closer?
Yeah, we've set up sort of clear rules of engagement as to what content you leverage, whether that's human resource content or paper-based or digital. We created a selling system for them, which is very easy and very user-friendly. So the way we're constructed is we have our frontline wholesaling team. We have a generalist alternative specialist team that cuts across everything, public and private markets, all structures that can come and represent for the wide swath of strategies that we have on the platform. We have over 100 alternative strategies across public and private markets, so they can represent for all of it. And then we have client portfolio managers that sit within each asset management team that we can deploy against the opportunity to and get really deep. So that's how we're organized. It's pretty kind of vertically integrated in terms of the engagement, and that's been working quite well for us.
What do you think is still missing in terms of educating distribution teams about private markets and then how to effectively distribute private market solutions to the wealth channel?
Look, I think it's all there. Again, I think providing flexibility of engagement and providing educational content through multiple mediums where they can consume it at their leisure, I think that's the key there. And then providing incentives for them to want to engage. I think the certifications, mean a lot to folks, and so we provide those opportunities too.
I think talking about distribution, you can't think about how to construct and run a distribution team without thinking about the third layer, which is organizational alpha. How do those two things link together, and what does organizational alpha mean?
We sell our asset management capabilities, and obviously, these are competitive markets, and so you talk about the absolute virtues, and maybe talk about how we compare to others. And then beyond that, there's, do I trust the sponsor? Do they stand behind their liabilities? Will they be there in a difficult market, right? Because as we talked about, environments change, liquidity situations change, the risk profile of the fund can change. And so I think people look at us and they say, hey, they know how to manage risk through cycles. And I trust them when liquidity gets tough or markets get volatile. They know how to handle that. They can steer me through it, and they're good stewards of capital. That's what we are fundamentally. So I think that's sort of the organizational alpha. We are Prudential, we are the Rock of Gibraltar, and people feel safe working with us, especially if you're in a fund where there's some sort of inherent asset liability mismatch there. I think they feel confident that we know how to manage liquidity in an open-end structure. We've been doing it for decades, right?
You mentioned something that ties with another important trend that's happening in this space, which is connecting the brand to the DNA of a firm. You kind of just mentioned it in a sense, both in the name, Prudential, and the Rock of Gibraltar, this stability that you kind of have to see over a long period of time. How do you think about brand and showing that brand essence to clients that you're working with across the wealth channel?
As it relates to alt specifically, yeah, look, I mean, some of the most prominent alt players today who have the largest market shares in 2010 were not really a known brand to the wealth channel, right? So they are now. I think a lot of that has to do with product and innovation, right? But I think a lot of that has to do with, there's some risks here that, are not present in traditional public market investing. And so, fundamentally, can I trust this firm? And I think people look at us and I think we emote trust. I think they feel comfortable working with a firm like ours. And again, if things get challenging, we'll be there.
I think as we think about private markets going forward, we talked about this a little bit as well. There's going to be these hybrid solutions. Firms are either going to do it themselves or they're going to partner. Picking who you're working with really matters because these are long-term partnerships. They're long-term products or solutions. So making sure that you actually pick the right partner from the outset is going to be really important.
So important. And when people look at us, I mean, they, in a lot of cases, want to partner with us because of our distribution. We have sort of really good and sort of vast distribution capabilities globally. So a lot of our conversations are around tapping into that. Beyond that, though, on the insurance side, right, we have a big pool of capital and that's growing. And again, this sort of self-reinforcing business system that people want to plug into. They want to be part of the asset pool against those liabilities. And so, we get that. Sticking with the insurance side, tax advantage strategies are becoming more and more prominent in the market. And so you think about things like private placement, life insurance, annuities. We're a significant writer in that space. And a lot of firms want to partner with us on that side and do partner with us already. But I think there's other more creative ways that we can work with firms on that side of the house as well.
How do you think asset managers should think about working with insurance? I mean this in two contexts. One is there's the general account, and then two, there's the distribution element. We've seen other firms partner alternative asset managers with insurers as a way to distribute products. You have the general account as well, which becomes this interesting way to both invest in your own strategies or partner with other firms in interesting and different ways. How do you think about firms looking at you and saying, hey, this is a really interesting firm that we can work with in a number of different ways?
Yeah, I think you're right. There are a number of ways. And on the insurance side, there's the general account balance sheet. We have a defined benefit plan at Prudential, so you could potentially partner there. We also manage pension asset and liability risk for third-party pension funds as well as insurers and other institutions. So, there's a lot of opportunity on the institutional side, if you will, a lot of opportunity on the general account side. And then on the wealth management, or on the asset management side too, there's a lot of opportunity there, which also can tie back to the insurance side, the example of private placement insurance and annuities. And then there's a retirement opportunity too. You may not know, we were one of the first to bring alts to the DC market back in 2006. So, we have a daily valued real estate product that's been in DC for nearly 20 years. And the market there is massive.
How soon do you think it'll be before private markets solutions are embedded in retirement plans?
They're there, or we're there. Yeah. They're there. Yeah. So it's already happening, albeit to a minuscule extent. And I think the growth will be slow to come, right? Like it was in the defined benefit side 20 years ago, right? We've had to get all the stakeholders, the plan sponsors, the consultants, the advisors. Everyone's got to get comfortable with the risks. And clearly there's a lot of regulatory scrutiny here too. And maybe that's starting to become a little more relaxed. But, there's a lot to solve for there. It will happen. It's just how fast will it happen?
What are you most excited about looking forward in private markets?
Well, look, they're growing. More access to them is made more broadly made available to wealth, which I think is great. I do think there are going to be some winners that win disproportionately to others. And I do think that speed to market will it's always mattered. It will matter more given all the competition for shelf space.
What do you think it's going to take to be a disproportionate winner?
Well, I think we talked around a lot of it. I think you have to have a good breadth of capabilities, but also like requisite capacity within it, right? So, a lot of wealth platforms will concern themselves with, the strength of the manager, the quality of the fund, the investment capabilities, but also, can they do it at scale? I think that'll be really important. And are they truly generating alpha, right? You generally find out in difficult environments. Are they really providing, true credit alpha and not just beta? Are they bringing operational expertise to their private equity capability, right? Do they have some, data advantage in their real estate business that, others do not? Some sourcing advantage, those need to be sort of conveyed, up front, and then that needs to flow through the P&L too, and manifests itself in the performance, right?
I think what's so fascinating about how you encapsulated what some of these advantages for firms are is that it really is in many respects about scale. You talked about Prudential's platform being one of scale and how that is a differentiator. I think that's a great way to wrap this all up because it really ties in so many different things that you talked about. So thanks, Tom. It's great to have you on the show.
It's been a great conversation.
Likewise. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going